Hi guys, hello everyone, and today we will talk about crypto should disrupt current anti-money laundering practices, not adopt them. Better known, your customer anti-money laundering regulations are ineffective. Crypto represents a better option to address this problem. Until the early 20th century, highly respected doctors would routinely engage in bloodletting to cure ailments ranging from acne to tuberculosis. While we have left bloodletting behind, we are still engaging in brutally helpful barbarity disrespectful practices. Modern know your customer anti-money laundering regulations are equivalent to financial bloodletting today. They do little good and may cause a lot of harm. Yet, whether we like it or not, nightmare is coming to crypto. A few weeks ago, news broke that a consortium of US-based crypto companies had formed Trust, a travel rule compliance platform that expands financial surveillance. Incorporated companies must abide by a law of their local jurisdiction, yet crypto shouldn't blindly follow legacy AML rules from the Financial Action Task Force, the Global Money Laundering and Terrorist Funding Oversight Group. It should disrupt them. A recent phenomenon, the idea of money laundering is a relatively recent one. In 1970, Richard Nixon passed the euphemistically named Bank Secrecy Act, which required financial institutions to spy on their customers. Keep in mind, Al Capone and other US mobsters had already been successfully prosecuted for tax evasion 40 years before the Bank Secrecy Act was passed. Since then, the scope of surveillance has grown exponentially. For example, banks in 1970 were required to report transactions in excess of $10,000. Today, the limit remains $10,000, but the $1,000 in 1970 is equivalent to $33,000 today. Only after the 1990s did the rest of the world criminalize money laundering, mostly because of the US pressure after the 2001 terrorist attack on the World Trade Center and Washington, D.C. What have the result been of the policy experiment? According to financial crime specialist Dr. Ron Paul, very little. Currency AML rules don't stop the vast majority of money laundering. The United Nations estimated that less than 1% of all criminal assets are seized globally, meaning that over 99% of criminal assets get laundering with impunity. While would criminals use the relatively small cryptocurrency market to launder funds on a public record, when they can easily launder billions through the conversational financial system without a trace. AML regulations also come at a great financial cost. Worldwide spending on AML and sanctional compliance by financial institutions is estimated to exceed $180 billion a year, about 100 times more than the $1 billion to $2 billion in criminal assets that get seized initially. Social costs are also high. The bureaucratic rules designed to keep criminals out and disaffection millions of legitimation customers more often than non-organized organization group. If you live in a small or poor country, you might find it possible to jump through the arbitrary hoops designed by a San Francisco product manager on the advice of a London lawyer. The author has personally been locked out of an account because a small Euro government-issued document was not acceptable by the address. The company's kick service couldn't comprehend that there are places where people do not use utilities bills to prove residence. IML department in official financial service companies are more about complying with AML legislation than actually stopping money laundering. A 2014 study found that identity verification principles, guidance, and practices resulted in processes that are largely bureaucratic and do not ensure that identity fraud is effectively prevented. In other words, fraud has been growing at astronomical rates worldwide, and gig laws have greatly contributed to this. People are not assumed to share their personal identity documents with a wide range of actors, ranging from banks to telecom providers to pornography websites. Is it surprising when their information gets compromised? Crypto is well suited. How can cryptocurrency disrupt AML regulation? Cryptography-based ecosystem are will serve for providing identity and source of funds. Moreover, they can do so in a privacy-preserving and transparent ways. For instance, you could open account at a centralized entity anonymous using a public key verifying by a trusted authority. That way, you have to trust only the entity with your details. A similar privacy preserving method could be used in decentralized finance using zero-knowledge proofs. Indeed, there is evidence that crypto is starting to disrupt sanction enforcement. Coinbase announced that it had limited access to its services in 25,000 wallets that may be related to sanctioned Russia's. The non-custodial privacy-focused wallet Wasabi was announced that it will be blocking sanctioned addresses from its coin-join pools, meaning that users can be identified will they want to be mixing funds with sanctioned individuals. This measured while considering that censorship-resistant Ether of cryptocurrency generate much less collateral damage than the blanket bans and creeped surveillance of the current remage. Although the medical bluesling was probably well-intentioned, over centuries it caused a lot of unnecessary suffering, come at great society cost, and did nothing to treat diseases. The cryptocurrency industry was born from the realization that the modern financial system leaves individuals vulnerable to abuse by trusted third parties. The current regulatory hodgepodge of FATF driving kicks and AML regulation have burned ineffective systems that do little to stop money laundering. Instead, they enable political censorship, financial surveillance, fraud, and inequality. The cryptocurrency industry should lead by example through the use of new innovative and effective anti-crime methods instead of forcing old ineffective ones. Okay guys, thank you for watching this video. Please subscribe.